Right now, shares of ePlus, ticker symbol PLUS, are trading at $88.48. That's a solid intraday gain of $3.60 or 4.24%. The market is clearly digesting this name, and what we're seeing today isn't happening in a vacuum. This is the immediate follow-up to one of the most explosive post-earnings moves we've seen this quarter. The common belief, the general expectation for a company like ePlus is that it's a stable, perhaps even boring, IT solutions provider. It's part of the market's plumbing, the kind of company that gets overlooked while all the attention flows to giants like Apple stock or the high beta narratives of Tesla stock. But the reality, as delivered in its earnings report last week, is that this boring company just crashed through a major psychological and financial barrier, and investors are being forced to completely reevaluate what this company is and where it's headed. The spark was its fiscal second quarter 2026 earnings report. On Friday, the stock absolutely rocketed, closing the session up nearly 16%. Today's 4% climb is simply the market confirming it likes what it sees. The headline number that shocked everyone was that ePlus achieved over $1 billion in gross billings for the quarter. This wasn't just a record, it was a milestone. It signals a fundamental shift in the scale of the business. The expectation was steady, modest growth. The reality was a 23.4% surge in consolidated net sales, hitting just under $609 million. This blew past analyst estimates, which were hovering closer to $533 million. But the really critical piece, the part that separates a good quarter from a great company, was the operating leverage. Adjusted EBITDA didn't just grow with sales, it increased at twice the rate of net sales. This is the core of the story. It means that as the company scales, its profitability is accelerating. Every new dollar of revenue is becoming more valuable to the bottom line. The adjusted earnings per share came in at $1.53, crushing the consensus estimate of $1.23. This isn't just a small beat, it's a fundamental misunderstanding by the market of the company's earning power. So what is driving this? Why is this happening now? The narrative for the last year has been dominated by artificial intelligence, personified by the meteoric rise of NVIDIA stock. But while many investors, especially those new to online investing or using a SoFi Invest account, are chasing the chip makers, the real, tangible spending is happening one layer behind the scenes. ePlus is capitalizing on this perfectly. Their earnings call highlighted that this growth wasn't from selling basic hardware. It was from providing the complex solutions that enterprises actually need to deploy AI. This means the high-end compute, the data storage, and most critically, the security infrastructure. This is where ePlus truly shined. Its security products and services division saw gross billings spike by more than 50% year over year. This is the reality that investors are now scrambling to price in. While a typical investor using the Robinhood app might be looking at Robinhood fractional shares of a big-name brand, the sophisticated money, the kind flowing through Fidelity Wealth Management or being analyzed by traders on an interactive brokers platform, is seeing a massive enterprise spending cycle in security. Companies are terrified of breaches, and the adoption of new AI tools only increases their attack surface. ePlus is directly benefiting from that fear and that need. This is a very different kind of investment than just buying Fidelity ETFs that track the whole sector. This is a targeted play. Many people looking for investment help are pointed toward diversified funds like Fidelity mutual funds or automated Schwab intelligent portfolios. And those are fine tools. But the opportunity for an investor doing their own research, running their own individual brokerage account through a robust Fidelity trading platform, or even the SoFi trading platform, is to find a company like this before it gets re-rated by the entire market. What ePlus actually does is act as a technology solutions provider. Think of them as the master architect and general contractor for a corporation's entire digital world. They design, implement, and manage complex IT systems. This isn't just reselling, it's high-level consulting, professional services, and managed services that create sticky, long-term relationships with clients. They are essential. This isn't a discretionary purchase for their customers, it's the cost of doing business in a digital-first, AI-driven world. This is why the narrative that this is just another hardware reseller completely falls apart upon inspection. Now we have to look at the full picture. It wasn't a perfect report, and this is where investors need to be critical. The expectation versus reality framework demands we look at the risks. Buried in that strong report was a notable weakness, the state and local government vertical. This segment saw budget constraints and weaker performance. This is a real headwind. It shows that not all customer segments are firing on all cylinders. Furthermore, the gross margin in their professional services division actually ticked down. Management was clear this was due to the acquisition of a company called Bailiwick, which simply has lower margins than ePlus's legacy services. This introduces integration risk. Can they bring those margins up? Or will this acquisition permanently dilute the company's high profitability profile? The market, in its excitement over the billion-dollar billing number, is choosing to ignore these risks for now. But a smart investor, whether they are focused on SoFi stocks or managing a complex portfolio on Interactive Brokers, keeps these facts in mind. This is the tension in the stock right here. Incredible top-line growth and security strength versus margin pressure in services and weakness in a key government segment. Looking forward, management felt confident enough to raise its full-year guidance. They are now projecting net sales to grow in the mid-teens %. This is a strong signal. The catalyst is clear. The enterprise spending cycle on security and AI is not a one-quarter event. This is a multi-year trend. This is where the opportunity for self-investing really clicks. You're not just betting on a number. You're betting on a durable trend. While the headlines are full of Tesla stock volatility or Apple stock's latest product cycle, the quiet, powerful story is in the infrastructure. It's a fantastic example of where an online investment strategy can pay off. This isn't a gamble on Robinhood crypto. It's a calculated position on the digitization of the global economy. Comment below with how much of your portfolio is dedicated to cybersecurity stocks, or if you think it's an overhyped sector. I'm curious to see what the sentiment is. It's one of the few areas where spending remains robust despite broader macroeconomic pressures. Many investing sites will just show you the chart, but they won't explain the why. The why for ePlus is that it has successfully transitioned from a value-added reseller to a critical solutions partner. They are now in the same conversation as much larger IT consultants. For investors on the Fidelity mobile app or those just starting their SoFi investing accounts, this is a lesson in looking at the entire supply chain. Don't just look at who makes the chip, look at who builds the data center, who secures the network, and who integrates the software. Often, that's where the most durable and overlooked profits are found. The team at Interactive Brokers, with its focus on Interactive Brokers trading and global markets, would see this as a pure play on North American enterprise IT strength. The people using Robinhood stock trading might miss it entirely, as it doesn't have the brand name recognition. This is a professionals stock that is now having its mainstream moment. To bring it all together, the story of ePlus is a classic case of reality-shattering expectations. The expectation was a sleepy, reliable, single-digit growth IT provider. The reality, as proven by the numbers, is a high-growth, high-leverage security and AI enabler that just crossed a major financial milestone. The 16% surge on Friday wasn't a fluke, and today's 4.24% climb to $88.48 is the market's stamp of approval. The market is fundamentally reassessing what this company is worth. The narrative has been broken, and a new one is being written. One of a company that is not just participating in the AI and security boom, but is actively and profitably driving it for its clients. This is a story of deep operational excellence meeting a surge in demand, and it's a clear signal that the plumbing of the tech world is where some of the most compelling stories are being found.